I'm Geoffrey Wynne, partner at Sullivan and Worcester's London office, and I head our trade and emerging markets practice. And welcome to the last webinar of 2025, but also the chance to move on to 2026 with, I hope, greater strength and purpose. But what I'm going to do is to have a look at what's happened in 2025. Um, to see what can be done and what we might expect and what we might be able to do in 2026. Uh, there is a question and answer button and a chat button if you have any questions. So let me go ahead. So the first thing I'm going to do is what am I going to cover? Well, I raised the question, trade gets paid, does it? And certainly one of our very good contacts and clients simply said it does on that. Well, let's see if that's right. Uh, there's been a lot of different insights into trade, what is trade, and so on um, in the last year. And in fact, almost on a daily basis, I'm getting all sorts of views. Most recently, there's been BAFT papers, there have been TTP papers, GTR papers, there have been conferences discussing matters, uh, the views that have been expressed with comments on LinkedIn and beyond, raising issues like there is a liquidity problem for SMEs. That's the problem. Are there any solutions? Of course, digitalization and AI come up, ESG. It's really quite hard to keep up, but I'm going to try and do this and try and cover all of this. And I'm going to sort of kick off, if you like, as you might expect, with the war stories of 2025 to look at why did transactions parties go wrong, but actually, of course, to tell you a lot about what goes right, and then to look at what 2026 has in store, how to react to what is going on. Can we make the market bigger and better, or are we just making the existing market processes just go faster? Well, let's see. So if I step back to the back to basics question, what is a trade transaction? And I'm just asking all of you and everybody in this marketplace to bear in mind that we're looking at financing trade. And one of the problems that have arisen is the use and abuse of the word trade. Uh, and so, one of the suggestions I'm going to come back to is would it help if there was a narrower definition of true trade? And if we did that, what would that achieve for all of us? But the first thing is to look at, well, how is financing obtained? You need to know how financing is obtained, how it ought to be obtained, and consequently to look at what happens if it goes wrong. And of course, it would be better still not to get involved in a transaction that goes wrong in the first place. But the sort of, if you like, the misdemeanors that I'm going to look at are the misdescription in transactions. Yes, I'm going to include first brands. I'm going to take another look at other bad results and then look at the common threads. And surprise, surprise, it's the same stories. There's been fraud, there have been double invoicing, double pledging of goods, wrongly described invoicing, non-existent goods. And there's a general failure to spot suspicious trade documents. And one survey said that's been on the increase in 2025. And that, of course, gets back to a discussion about is a digital solution one answer to this? And you'll see that perhaps, but how did we get to this? Well, things going wrong in trade finance is always a good news story. It gets back to what I regard as the fallacy that trade is inherently risky, because that's what those who deal spot say. But of course, the size of deals that go wrong is usually large. if you're going to defraud, why would you do it for small amounts? It's usually noteworthy. But the point is, it is disproportionate to the trade market as a whole. In other words, there have been multiple successes in trade finance, and those are generally unpublicized, or certainly don't get the same level of publicity and discussion as the ones that go wrong. We have trade registers. The ICC is helping with all of this, and that gives statistics on that. But we have to bear in mind the very conservative view of the banking regulators, who really see their job as protecting the banking system. And consequently, the bad news stories cause reaction, probably overreaction. And if we want to get back to how we want to see trade finance, we have to describe transactions more clearly. If you want to be successful, that's what you need to do. So if you look at a summary of problems and risks 2025 style, it's clear the collapse of First Brands and the other failures of Greensill, Sten, Altis show that non-bank trade finance can be structurally fragile. And I use that term sort of in a polite way, because there are problems if you build structures and transactions in an opaque way with off-balance sheet debt, and there's just general weak governance. And the criticism is that there are systemic vulnerabilities because of poor due diligence, over-reliance on things like trade credit, fraud, instead of looking at documenting, transacting real trade collateral. And so the securitization and structuring can mask real risk. You can have fractured chains of intermediaries across jurisdictions, so that historically and sadly currently, the perspective is that you use some of these methods to create bad transactions. And so the failures often cluster around the volume-driven invoice and receivable finance models, prioritizing yield and growth over actual trade verification, or indeed just looking at the underlying physical goods involved in the transaction. And of course, that risk gets magnified when multiple transactors, lenders, and investors, and you suddenly lose and obscure the liability. Losses get distributed widely. So there's not a single point of collapse other than in the very vehicle, but it doesn't remove the underlying credit risk within specific transactions, which have been poorly documented. But conclusion, trade finance still gets paid, but it really needs to be backed by real verifiable trade collateral and goods. And when you detach the financing from the real goods and you rely on receivables in opaque structures, payments can be fragile. And what I mean there is you get default, non-payment, and loss. And so what are the lessons from 2025? Well, in some ways, it's the same as 2024, but most trade transactions perform. The financing of most trade transactions, and that's my emphasis, are repaid. And so the question is it the complexity of transactions that cause problems? May well be. When there are overcomplicated structures and the financing is removed from the trade flows. I'm not saying that we shouldn't. I mean, indeed, we do structure transactions, but we need to do that in the clear understanding of what we are actually financing, because a lot of the financing transactions have been misdescribed, called supply chain finance when they're clearly not. The sale of future non-existent flows as supply chain finance, First Brands and Greensills before it. In other words, it is not supply chain finance that's a defective product, but it's the use of that term. You can finance future flows. In fact, we do a lot of structuring of future flows. In other words, taking performance risk before a receivable is generated. but that needs careful documenting and explaining, and will work if it is structured properly. So what should have been done? Well, I'm going to introduce some ideas, some discussion about what is a trade transaction. And it's certainly not what you hope it might be there, not what you hope is there, but you need to look at what you are financing, what the risks are, and what the risks that are being taken and who's taking them. Physical risks, the supply chain, the physical supply chain can work. And should be financeable, and indeed is financeable. But due diligence is the key. It always was and always will be. But due diligence is not one-off. It's a continuing obligation, if you like, of those involved throughout the transaction, as indeed is documenting the transaction properly. Not even good documentation will save you if the transaction has been wrongly structured, wrongly sold. But you need the documentation to enable the due diligence to be carried out throughout the transaction, and the parties then to comply with the specific terms of the transaction. What we're seeing is solutions emerging and opportunities arising. It is clear that there is a shift to digital trade. Finance. It's gained traction. We have electronic bills of lading. We have blockchain and other platforms designed to reduce documentation and fraud risk. Indeed, it almost certainly does, but it's not necessarily the only answer. The improvement of transparency is useful. The speeding up of settlement and the cutting of costs, I agree, that is helpful. But the speed and the cost cutting, you need to look who is benefiting from this. And there's a step back. Traditional banks are under pressure to modernize, and many recognize they need to adopt automation, AI, and digital solutions, or they will be left behind. And there's a note: regulators, please be aware of this. This should be encouraged and not allowed to create problems from the very banks you're regulating. And we know there's an increasing interest in institutional investors in trade finance and working capital funds. Trade is very good. There are strategies announced by large asset managers funding receivables and trade loans using this very capital. But the question in all of this is, what does the institutional investor want or need within the transaction? Does he need a rating? Does he want quality? What return does he want? Remember that risk and reward go together. You can't expect a strong transaction to produce as high a return as one where there is risk analyzed and taken. This is all related. And the problem invariably in financing trade finance assets is that they are short term. So volumes are needed, and there's a danger just in how you repeat transactions. In other words, the first transaction looked very good, the second, and so on. And then the sixth transaction, that was the one that had the defective invoices and so on. But we have lots of tools on offer. There is a lot of pressure to digitize trade transactions or part of them. But as commentators are saying, the digitalization of the full trade transaction most of the time is not there yet. Digitalization is not the solution, I would suggest, but it is certainly part of a solution. And I'm not putting down any of these solutions because they do provide options. But one of my issues on a lot of what is going on, are they aimed at existing trade flows and existing transactions? And are they making them quicker, which is good news? But are they expanding into trade, providing means to get more trade? I put in the middle of this slide legal entity identifier, LEI. There are major potential steps forward being taken, and I do regard this as a very key element because part of the issue that parties have is the inability to identify that they are dealing with a genuine party. This will help SMEs, it will help those who need to carry out KYC, but also the ability then to have better documentation in support of the existence of an entity logged in a common place to save time in having to due diligence a party and its documents time and time again. This will solve a lot of the problems, I hope, of bringing in new counterparties into this marketplace. In other words, particularly the SMEs, could benefit if countries or regions roll out LEIs. The platforms offer many solutions, but one of my issues is how many of them go beyond proof of concept, because it's the same point. If you are demonstrating that the use of a particular platform or whatever makes an existing transaction go faster, that's good. But the issue for this marketplace is scalability. How can we scale up what we have so that we do increase satisfactory, solid trade transactions? And who's going to approve all of this? Bodies like the ICC becoming involved in approving some of these solutions. Back to regulators, will you approve solutions that are available to banks? If I step back for a moment, financing of trade can be done in very different ways. Financing of trade, remember, we can do it by way of loans, secured loans, PXF, prepayment financing, tolling facilities, borrowing base structures represent a very good way of financing all the way down the physical supply chain. There are different facilities that can be made available. The use of letters of credit, issuance of guarantees, receivables and payables, the true supply chain finance transactions. All of this is available, and we have some good standard documents available in the marketplace to help set us on the right path. The ITFA Master Accounts Receivable Agreement for supply chain finance, BAFS Participation Agreement, which I'll talk about in a moment, the Master Trade Loan Agreement for interbank financing. The LMA has a suite of documents, and there are also lots of structured documents around securitization. It's clearly good to package up supply chain finance transactions using securitization vehicles if they are truly supply chain finance assets. And what about the quality of what is put into the securitization? Bearing in mind, as I said before, that these may well be short-term assets and the need to replenish them. So that we have lots of ways of doing this. The question, but what's the trade finance market looking for? Is it just looking for better quality assets? Is it looking for speed of executing transactions, as I said, existing transactions? Or is it looking for what I hope we can discuss, which is financing the trade finance gap on that? We know there is liquidity in the market, those who would be prepared to invest. But the question is, how can you finance SMEs in emerging markets in particular? And part of my focus has been, is, and I think will be for 2026 and beyond, is what can we do in that marketplace to expand the trade finance product, which can be and should be an inherently good product. Now, I recognize there's a problem for larger banks in particular. they are being held back because of compliance and regulation issues. On that KYC onboarding is an issue, and that really does need to be resolved. If it's by fintech tools, that's great. And that's what regulators in particular need to address on that. Who else could you involve? Well, NBFIs and funds, DFIs, insurers are already involved. Can we with them do more? And I think I've got some ideas on that we should be looking at. The non-banks, they can help fill the gap. But the moment there is focus on the failures, artists, first brands, etc., that demonstrates to them and indeed to those of us involved that without adequate transparency, some of the models that are produced for financing are fragile. They can go wrong. So where there is a disconnect between finance and real trade, where you are inviting the financing simply of receivables or invoices without verifying the underlying shipments, the goods, so that finance becomes decoupled from the economic activity, i.e. the true trade transaction, then there is an issue about undermining the value of the financing. Is it safe to do it? And one of the points that gets me that argument that true trade perhaps should have a priority in insolvencies, in rescues, where there are real goods, there's a proper supply chain transaction, and then trade creditors and those who finance trade creditors should be protected ahead of securitized transactions because they have a different focus outside of the real economic value of the transaction, i.e. the trade transaction. And that means that if you finance a trade transaction, you may then get priority over all other creditors. That means that there will be greater institutional interest in trade finance funds. If the underwriting is more disciplined, if there is a real trade collateral and transparency, and then the use of technology and platforms to verify those flows would be important. And that goes for all the other parties involved in the transactions. Insurers as well becoming more involved. And it's a plea that I would make on behalf of the insureds that some of the insurance policies are very complicated. They lack a flexibility to recognize the trade flows and the obligor that needs to be insured on that. Because if we can get to this point, can we answer the question, will this filter down to SMEs and to the emerging markets? And the answer could well be yes, it can, will, and should. So what will 2026 offer? The good, the bad, and yes, the ugly. Is this going to be about solutions or is this going to be about repeated problems? And that's what I'm going to look at in the next few slides. I'm going to touch on the ESG dilemma as I see it, look at some new laws and regulations and obstacles and assistance from these laws. Before I go on to what might be there, let's look at what is already there. On that. In other words, have we got some solutions staring us in the face that we can use in 2026? Well, do we have digital solutions? Assuming we want digital solutions. The UK and English law and many other markets have allowed electronic signatures. So we don't need the paper that is being generated. We can deal with things electronically. We can click acceptance. Letters of credit have been there for ages. EUCP has been around for a long time. Most of you who issue your letters of credit do it as SWIFT. you've been doing it electronically. We know electronic bills of lading are now available on that. We know electronic promissory notes and electronic bills of exchange. All of those, as a matter of English law, have been possible since the Electronic Trade Documents Act of 2023 on that. Melita, the model law on electronic transferable records, has been rolled out around the globe so that these legal solutions to digital problems are already there. The platforms using ETDA and so on, and other contractual solutions, including in the electronic bills of lading space, are there. They may often provide contractual solutions, but they are solutions all the same. Let me mention URDTT, the Uniform Rules for Digital Trade Transactions. This has been available for a number of years. We're getting on to 8 years on that. One of the points posed by somebody with whom I work very closely is it time for URDTT? Is it time? Do we need to amend it, or can we use it? But remember, these rules started for a digital trade transaction. That's a transaction between a supplier and a buyer on that. And the focus has often been at other parties and not at suppliers and buyers. Trade finance should focus itself on suppliers and buyers, and then we have the means to digitalize that very trade transactions. Bringing other parties in, again, just looking at documents, we have the documents. We have the BAFT, Master Risk Participation Agreements, which work for both funded and unfunded participations. We have the separate ITFA unsecured document, literally for unfunded risk participations. We have the ITFA MARA for sale of supply chain finance assets. I mentioned before the BAFT Master Trade Loan Agreement, a very useful document for large banks who don't want to be involved in due diligencing suppliers and buyers in emerging markets, can provide funding to a bank in that emerging market with whom they have a relationship to enable that bank to use that funding to fund into a trade transaction. So we've got structures to make all this work. We have investors, they exist, but explanations are needed because what we need to be able to deal with is how we can all cope, how they can cope when things go wrong. And of course, that turns us full circle of, well, 2025 saw things going wrong, but so did 2024 and so on. The message for 2025 is if we can stop things going wrong, or at least reduce the issue to, if you like, credit risk, i.e. non-payment or non-performance, we will get to a place where we can expand trade finance. Expand trade finance or contract it. I have been fairly vociferous about ESG in emerging markets, creating less opportunities and more threats because of, correctly, if you like, an obsession with sustainability, but without applying the tests to the relevant market. In other words, what might go for a fully developed market will not go to an emerging market. Therefore, what we need to look at is how to make ESG work in emerging markets by recognizing what that market needs. Less environmental, perhaps more social, more governance, and so on. And then if we can turn it to the advantage of trade finance, in other words, to say what we are doing is ESG compliant in a better defined sense, we can then increase ESG trade finance in emerging markets with SMEs. I digress slightly, although this is an important point. In the last couple of weeks, we have the Property Digital Assets, etc. Act of 2025, passed in the UK, creates a new statutory category of digital assets as property. In other words, to treat a digital asset as if it were a physical asset. You can only transfer it, grant security, recover it. It has, in my view, a potential drawback because it's the courts who will decide what token will qualify as a digital asset. But the door is now firmly open. Why does it matter for trade? You can tokenize receivables, invoice, trade assets. They are more reliably treated as property, use them as collateral, legal certainty where you've got platforms, making digital instruments more enforceable in insolvency and disputes. Participation becomes easier because those who want to hold digital assets and finance them have a law to look back on. It will support the development of paperless, tokenized trade ecosystems, moving assets digitally, but keeping property rights. Limitations. Tokens are not money. They're not regulated by this act. Not all digital assets will automatically qualify. Insolvency will be policy driven, not necessarily solved by the act. But this is taking us into the digital world that many of us see as being necessary. It's a great step forward. But what else? I just put up 2 bullet points, modern slavery and sanctions, as obstacles to compliance requirements. It again seems to require financiers, particularly banks, to police policies, which means it does not help the growth of trade finance. There is very little by way of regulation that helps trade finance in its wider sense. There's arguments about little bits of help in letters of credit and so on. But there is unlikely to be more. We are unlikely to find the banking regulator granting better treatment for trade finance in its widest sense. We can try, however, as you'll see, to get a little bit of help from regulators, from legislators on that. For example, there is an increasing rollout of Melita. More jurisdictions are joining. I think Australia has recently joined. The UCC Article 12 allowing digitalization has finally been adopted in New York. So what more do we need? Well, there are issues that are coming up all the time on the cross-border problems, and trade is essentially cross-border. And let me look at some of these cross-border issues in thoughts about what we might do going forward. I had the privilege to attend the ITFA TF COP recently. There were a number of presentations. I presented on potential changes to laws or regulations. And I'm inviting a group to join with me to develop ideas along the lines of what's in the next few slides. What is doable in 2026? Well, we need to think about that. But I think some of these ideas, coupled with what is happening, may well be doable even in 2026. Lots of solutions around, lots of digital solutions, they will clearly keep coming on that. And we have to, as lawyers, if you like, apply them back into the law that we have to live with. But it's not just English law, which I think copes very well, but as we translate the issue cross-border, we get the question from local foreign jurisdictions, foreign to the UK, of saying, well, this may work for you, but it doesn't work in my jurisdiction. And that's an issue. As I deliver an opinion today about the enforceability of English judgments and arbitral awards in other jurisdictions. So, what are legal and regulatory solutions that might be there? Many of you have heard me say this before. The mantra of trade gets paid. Well, does it? Well, the answer is trade should and would get paid, but there have been abuses of using trade. Can we avoid those abuses if we have a limited definition in some transactions that we want, where we define true trade and the finance of true trade? Is it a supplier and buyer only, or sequential suppliers and buyers? Should it be limited to the import and export of goods to and from a particular buyer's country? Should we focus on the buyer, i.e., the party that will be paying ultimately for what is produced, shipped, and so on that? Should we limit any of the benefits that we're talking about to SMEs using an accepted definition on that? Let's explore that a bit further. The regulatory treatment for banks, as I said, I don't think that we are going to get the regulator, certainly the regulator of banks, to agree any of this true trade. But it may help within banks and within other parties to get more trade done if we can define true trade. And therefore, what I've been looking at is whether should there be other regulatory or legislative solutions on a country-by-country basis that would provide a priority class of claims in a buyer's insolvency, perhaps just for SMEs, perhaps limited to the maximum or a percentage amount of debts. Do you couple that with, or have instead of governments agreeing that foreign currency in a particular country will be available to pay trade debt in priority to other claims? How can you do it? How can you create priority claims? It's not been done, has it? Well, I'll just take you back in the 1980s, in the Latin American debt crises. Short-term debt, primarily trade debt, was paid and was paid ahead of other debt, was not rescheduled, partly because it was easier to do it. So it was doable. In certain restructurings, Kazakhstan banks, some years ago, we created a class of true trade to get those debts paid ahead of others in an insolvency. So it has been done before. It has been looked at. And I think it is well worth looking at some solutions in that area. What about other areas? Well, there are attempts and continuing attempts to create definitions. Can we make them legally effective? If you follow my argument of true trade, what about trade finance? What about prioritizing trade finance claims? And as I mentioned before, LEIs. So what I'm not looking at is not so much an industry code of practice, but something that's legally effective. In other words, you sold me a trade transaction and it wasn't. You are going to be liable. How could we do this? Well, perhaps other ways. UNCITRAL, for example, has provided model laws in the past. Would they help define trade, its ranking, who can finance it? Could that then be adopted? Will the ICC and other bodies force the adoption? What about political areas, a harder EU, and so on? The DFIs have been very good in providing support to banks in transactions, working with banks, letters of credit, confirmation of letters of credit, first loss guarantees for buyer trade debt. Can we enhance that? Should we give DFIs insolvency protection? Should there be government action in developed markets to make this better, in emerging markets to make whatever we want to achieve more achievable in trade, in true trade, and so on? And this takes you back to issues of the education and other actions. We need to explain more what we do. In other words, what is trade finance? What is, therefore, true trade? And these current solutions are aimed at non-bank financial institutions and funds. And that's useful because what it is saying is if we can have consistency of terms, we can help assist an NBFI or a fund in not investing in the wrong assets. In other words, avoiding structural problems that I talked about at the beginning, because what is being offered is actually what it says, if you like, on the label on that. Separate point, because should we improve the quality of payables from buyers? Can we ensure that the payment obligation is clear? Can we have an unconditional payment undertaking? And that takes us back, if you like, to bills of exchange and promissory notes, the old Bills of Exchange Act in the UK of 1882, an unconditional promise to pay a sum certain on that. We digitalize that. Well, we've done that. ETDA in the UK specifically addresses electronic promissory notes and electronic bills of exchange. Melita in other jurisdictions could do an equivalent on that, or it could allow the selection of English law, English promissory notes and bills of exchange. But who creates that unconditional promise? It's the buyer. So this takes you back to the need to approach suppliers and buyers in the first instance to say, look, if you can accept that instead of all your terms and conditions that you use, your invoices and so on, that ultimately, where you are ready to pay a transaction, for a transaction, that you will issue that unconditional promise, that opens the door to more trade finance. And there are leading players in this market, leading buyers in this market, who are taking banks down this very route of using the digital promissory note and bill of exchange. If we can do that, we can go back to URDTT that I mentioned before, because we can then document those transactions electronically. But it depends on the approach that banks are prepared to take in relation to this, the need to work with other parties. That includes the platforms, but it takes you back, if you like, to legislators, to regulators, helping buyers and suppliers to get a properly documented trade transaction to finance. Now, there's quite a lot of discussion that's going on in this whole issue of what is supply chain finance, because there is a need, it seems to me, and certainly in a publication recently from TTP, the Guide to Supply Chain Finance for Corporates, to explain what is supply chain finance, because there's a mixture. It can be receivables, it can be payables, it could be factoring, could be forfeiting, it could be inventory finance. Because what's important, if you explain what supply chain finance is, you can then explain what supply chain finance is not. And you can say, if you want to invest, you are investing in supply chain finance because it is one of these, or you can see there is a transaction that is not supply chain finance. You may well want to invest in it. You may well want to take buyer risk. You may well want to take producer risk on that. We can have financing transactions. We can credit insure the performance, if you like, of the producer. It's just not supply chain finance. And consequently, what we are really looking at is that where we define these issues, we're trying to address the challenges of what are the risks in transactions? Who knows the risk? Who is being invited to take that risk and that risk alone? I had slides when I've talked about financing trade that looked at this. If you're an institutional investor, a fund or whatever, you may well say, look, I just want to take the credit risk of a buyer not paying on that. I don't want to take documentation risk. I don't want to take all this performance risk. I want to know that the asset that gets put into whatever your structure is a buyer payment obligation. If the buyer doesn't pay, I take that risk. I've analyzed that risk. The operational risk is not mine. Somebody else needs to take that operational risk within the transaction. That's what parties in this marketplace say they do, and they should do on that. That means looking at who's going to take the fraud risk. What is the fraud risk that we're talking about? There are technology solutions aimed at that, but ultimately the platform says, well, I've just facilitated this. I'm not taking that fraud risk. So somebody in the transaction has got to take that risk. There are lots of legal and regulatory framework hoops and solutions to follow. We can do this. We, in this marketplace, lawyers and others, we can document, we can structure in these transactions, but we need laws, we need regulators to help in order not to create the very tripwires that we're trying to stop. And the sort of tripwire that I would welcome many of you to go back to your local regulators and legislators is not accepting, for example, an English law promissory note, an English law electronic promissory note, bill of exchange. This idea of needing special regulations within a country in order to finance cross-border trade. That's the issue that is key to holding back cross-border trade finance in our marketplaces. Where's the guidance? Well, I've told you, there's lots of guidance around. Should we turn that guidance into better developed solutions, either from the professional bodies, from ITVA, ICC, BAFT, and so on, or better still from regulators and legislators who say, I get it. I understand we have to make trade finance better, more financeable. So what are the implications? Well, look, there's going to be growth in digital, paperless trade finance transactions, blockchain. AI-enabled technology is going to increase because clients, whoever your clients are, want faster, cheaper, transparent, particularly supply chain funding. But remember that if we're not careful, the very regulators and governance requirements that I'm saying help may increase if there are failures, and suddenly you see systemic risks of investor funds being at risk because there's not been the proper due diligence and transparency. Would we ultimately see minimum standards for trade finance lending? Is that a good or a bad idea? Well, look, it might be a good idea if coupled with satisfying that minimum standard, there was better treatment in insolvency, in regulation, and so on. The role of the institutional investor might expand and should expand, but remember, the success of involving this funding hinges on alignment with real trade flows and risk-aware underwriting, risk acceptance by various parties in a transaction so that the investor takes the very risk it thought it was taking on that. That's the mixture of the good, the bad, and the ugly, if you like. So in summary, well, look, there are many who are addressing the problems. I don't have exclusivity on that. We all know what many of the problems are, and many probably on this webinar and others have a lot to say. They say that they have solutions. And indeed, there are lots of useful solutions around. But remember, there isn't one size that fits all. This is a marketplace that by its very nature encourages all of us to structure for the particular rather than for the general. But learn the lessons from the past. Know that they may well be repeated, so be aware. Whenever I have talked about, if you like, fraud and so on, I have been able to go back to fairly old cases and say, people say, that rings true. That's what happened this time, because we know how people try and defraud. So be aware. But there are good transactions. There are good trade transactions, and we can continue to make good trade transactions. There are good ways to structure transactions. Most commercial parties in particular want to perform their trade transaction. Work with them on that. Listen to them, help them. And this way, I hope we can save in 2026, trade finance gets paid. I hope that was helpful. Let me just have a look to see if there are any questions. Feel free on that. Yeah, somebody comments that Melita's been around for a long time. Why have countries been slow to adopt it? Well, the answer is it's painfully slow because countries have adopted it where they have seen the need. Because either there's been a problem in that particular country or suddenly they see rivals doing it. It would be helpful if bodies like the international trade bodies, ICC and so on, encouraged it. If the EU were to encourage Melita adoption, that would be good. But remember, Melita is a model law on electronic transferable records. So it's looking at transferring, not necessarily creating those records. And that's why, if you like, there is an issue that we need to encourage, which is electronic records are fine. We can use them. But is there more? And the answer is, of course, there is more. There is more involved in trade transactions, and that's suppliers and buyers, who I suspect are not on this webinar on that. If you're a financer, if you're a platform, encourage suppliers and buyers to, if you like, buy into these solutions on that. I'll just wait a moment if there's anything more on that, because if there is not, then I'm very happy to give you back the last 3 minutes to wish you happy structuring. successful end of 2025, and of course, happy, healthy new year, and on to 2026 for trade finance to be bigger, better, securer. Thank you very much for listening.